Thanks for staying with us. My name is Darryl Kwao. Ghana is set to raise 10 billion Ghana cedis through its first domestic infrastructure bond as the government steps up efforts to finance roads and interchanges nationwide whilst rebuilding confidence in the local debt market. According to Bloomberg, the bond sale will be issued in two tranches of 5 billion cedis each in the first and second halves of the year, with longer dated tenures designed to attract local investors seeking stable returns. Bloomberg sources say the projects funded by the bond are expected to be largely self-financed through electronic road tolls, a structure intended to prevent additional pressure on Ghana's public debt. Joining me to discuss, Associate Professor of Finance at the University of Cape Coast Business School, Professor Seram Kawo. Good afternoon to you, sir. How sustainable is Ghana's plan to raise 10 billion cedis through a domestic infrastructure bond, given its recent history of high debt and the 2022 default?
Thank you very much. Good afternoon to you and the viewers. When we look at the bond issuance that we are going to have first half of the year and the second half of the year, we are coming from debt restructuring and looking at debt accumulation after 2022 crisis, where we have the domestic debt exchange that brought a lot of issues. It means that the bond that will come in, we must also have at the back of our minds that we have asked for debt relief, that is, for debt relief in terms of forgiveness of about 137 billion Ghana cedis debt that has been given. Largely, the money that we are going to have must fit into the IMF financial framework. That will be in line with the debt sustainability framework and then the medium-term framework that we have. The 10 billion falls within about 1.5 to 2% of GDP. And once it is coming in, sustainability will depend on three main conditions. These three conditions are: one, transparent selection of the projects that we need to have with a high rate of return so that it will grow in such a way that we will have the toll revenue that will fit into our debt to GDP ratio. Secondly, that there must be a strict ring fencing in terms of closing up the loopholes so that the services that the bond will bring will not be redirected or directed into recurring expenditure of the government. So we don't get the money and then we'll use the money for something else. The third one is that we want to maintain a primary surplus. If we want to maintain that primary surplus, then the bond must be such that we cannot just use it anyhow. We must start using it for the purposes that we are taking the money for, and not just another avenue for borrowing, and then we'll continue to borrow, and then we'll go back to the situation where our debts will not be sustainable.
What do you think is driving a renewed investor interest in Ghana's domestic bond market, and how might this influence the success of the infrastructure bond?
You know, in 2022, the debt exchange has brought some kind of discomfort to the investors that we have in the market. But then the confidence has come up as a result of the IMF program that we have, the progress that we have achieved throughout the domestic debt exchange and then the debt restructuring, and the clear issuance calendar that is being given now. We also have the macroeconomic situation improving over time, in the sense that we have inflation has fallen to around 5-point-something%. We have the cedi strengthening, the gold prices, and then the gold and cocoa prices have also improved over the period. And that has also given a more predictable situation. Now, the attractiveness of this particular bond, if it will happen at all, will be the long-dated paper that we are looking at. The bonds are not just going to be short-term, they are going to be long-term. And therefore, once it is having a long-term duration, it will be meeting the benchmarks that we have in the international market. There will be stability in terms of the revenue that we are going to get to cover up. So the road tolls, the electronic road tolls are going to come in. So we are not going to depend on the issue of government giving a budgetary allocation. There is a specific funding that is given for this. The other third point I want to raise is that there is a visibility of the project that we are going to use the money for. So we are going to use it for roads and interchanges. Once we are going to use it for roads and interchanges, what is going to help is that the politicians will buy in, the public will buy in, domestic investors know what the money is going to be used for. And that may be the one that will be driving the confidence that we have in the market.
Could the issuance of this large infrastructure bond crowd out the private sector or complement private investment?
My answer to that is that yes, it can crowd out. It can crowd out in the sense that there is a risk of the bond badly implemented, it is mispriced, and the timing is not very good. The institutional investors may not be having that amount of money to invest in it. Now, what is going to happen is that once we are issuing the bond, it is a risk-free kind of thing, but over the years, we can say that the bonds are no longer risk-free because it can be restructured and the haircut can come in over a period of time. The banks may feel that, okay, that is more stable, the income will come in, and so they will decide to give out to government over time. But then this crowding out can be reduced. It can be reduced, one, where it is targeted towards institutional investors, such as the pension funds, the insurance schemes that are there, which will match their mandate and whatever they are doing. Now, it can also be reduced where it is well coordinated with the Bank of Ghana, where the Bank of Ghana liquidity management system will set in such a way that it will not trigger any kind of sharp yields across board. It will complement in the sense that it will reduce logistical costs and uncertainties with private projects that are there. And when you are working with the private sector, you are developing industrial parks, real estate is improving, interchanges are working, then what is going to happen is that the banks and other financial institutions will be willing to provide funding for these businesses that we have.
Yeah, I want to touch a bit more on how this is going to impact on overall economic productivity.
You know, the road infrastructure and the big push that we are talking about, we have in our country transportation problems where travel time is very long, moving products from our production centers, the farmlands, the food crops, the manufacturing things, to the various ports of exports becomes a problem. And so that is going to reduce. What is going to happen is that the travel time will lower, operation costs of the maintenance of vehicles and all the rest will also be reduced. It's going to expand productivity and the labor market, thereby reducing that kind of urban congestion that we are having. It is going to reduce post-harvest losses and improve market access over a period of time. And then once the road network is improved, we are going to have connectivity to tourism, services, regional trade in terms of AfTA, and that will boost non-traditional exports that we are going to have.
Right.
So productivity payoff will depend mainly on the project quality and maintenance, where we have poorly built roads that are politically affiliated, then we are going to increase debt and then we will not get the returns out from these projects that we have.
All right. Finally, in a minute, if you can, we've seen inflation drop, we've seen the cedi strengthen. How do we then balance the financing of this infrastructure financing with the country's macroeconomic stability?
So we need to keep infrastructure bond within the IMF debt limit, the medium-term fiscal framework, to ensure that we do not go overboard. We need to prioritize projects with strong growth and revenue impact that will help stabilize the macroeconomic environment that we find ourselves in. And we must coordinate closely with the monetary policy so that the issuance will not affect the overall growth that we have. With inflation down and then the cedi being stable, Ghana has a narrow window to weather the storm, and we need a strong political will to navigate these waters.
All right. Good to see you. Thank you so much, Professor Sarah Mkao, Associate Professor of Finance at the University of Cape Coast School of Business. You are watching The Marketplace. We are taking a short break. When we come back, we've got the exchange. We'll be talking about the gold purchasing program. Don't go anywhere. Welcome back. Time for the exchange. Today, we're on the gold purchase program. The Bank of Ghana says it has tightened controls and reduced transaction costs under its domestic gold purchase program following the recording of audited losses over several years. The governor, Dr. Johnson Esiama, told Parliament's Public Accounts Committee that the program introduced in 2021 was a stabilization intervention at a time of severe foreign exchange stress, not a profit-making venture. The governor acknowledged losses recorded between 2022 and 2024, explaining they were driven by timing differences between local gold purchases and international sales, foreign exchange conversion effects, and structural costs in gold transactions. Joining me for the exchange, Associate Professor of Finance at the Andrews University, Professor Williams Pepra. Thank you for joining us. So, do the lower fees and charges make the domestic gold purchase program more efficient?
Thank you, Daryl, and I hope you are doing very well.
I'm fine.
If you look at it critically, what Bank of Ghana did was to address the administrative cost side. The main cost drivers, which the governor himself really identified, which were the pricing issues, the forex issues, and the timing differences were not addressed. So if you want to talk about efficiency, I would say that it was very marginal. Let me put it was modest in terms of just addressing the administrative costs. We could not achieve a full efficiency as we expected. That is why the losses were reported.
So could the Bank of Ghana's gold purchases and sales still affect local gold prices or the cedi even after these reforms?
Indeed, my answer would be yes. It's going to really have an impact. You see, the gold trade, even if there's no intervention, is a commodity that we trade in. So it brings in forex, which is we export and we get the forex. So it will have an intervention. What has really happened is the new model using the gold board approach, and then their efficiency to be able to make sure that government buys all the gold through gold board, and the Bank of Ghana will be the one to offtake it and sell it outside. This has really improved liquidity within the entire system. However, as we know, it's a new program, so there is still that kind of distortion, and we need to smoothen out, and that is why we're going through these challenges. I'm sure with time, is really going to help. One important aspect is it really addresses the expectation challenges when it comes to dealing with forex. And expectation is very key in determining forex. So once people know that Ghana will have gold to sell and Ghana is going to have forex coming in, it reduces that expectation in where people speculate. So expectation is addressed and speculation is minimized through this program.
And how effective do you think the planned structured hedging and cost renegotiations will be in reducing the timing and FX-related losses that the Bank of Ghana has historically faced?
I would say that Bank of Ghana must be very careful if he wants to go into hedging. For finance, we know hedging is just reduction of risks, but it's normally done when we see in the derivatives market. There is something we call basis risks. And when you hedge, your hedging does not match the actual exposures. Because we've just started this new process, and going into hedging may make it more complicated if we don't really understand the derivatives market. So the Bank of Ghana may have to make sure we have a good investment firm that is going to assist us in going through this kind of hedging process, and also know which part of the exchange that we want to use in hedging. And that is what is really going to help us. If not, the slightest deviation from hedging, you may lose big time. It's like, we call it a zero-sum game. You may lose all or you may win if you really want to go on that route. So we have to be careful if you want to really go into the derivatives market.
Do these reforms make the domestic gold market more attractive for private investors, or is it still largely dependent on central bank intervention?
I mean, the way it is, we have structured our gold board, and also having the gold for reserve program. The central bank will still need gold, so the central bank will still buy some gold for its reserve program. However, if the intention is to buy the gold and the spot to bring in forex, then we may have to open up and probably allow some private entities to deal directly with either Gold Board or with Bank of Ghana in terms of the purchasing. I mean, the new structure is all gold are purchased by Gold Board, and Gold Board will sell it outside. So if that is a structure, we should ensure that Gold Board establish reputable customers who they can trust, and not even one player, more customers, so that it will bring some kind of competition in who they should sell to. And this is very key.
And given the program's past losses, what key indicators should investors and businesses watch to assess whether the gold purchase program is financially sustainable in the long term?
So when it comes to sustainability, the best judge is by settlement discipline, and then also transparency and reducing dependency on the central bank. So I'm sure the central bank itself, as we know, is trying to move away from it, and we should be able to find with Gold Board balance sheet to be able to contain all the losses and gains that may come out with the transaction. For investors want the Gold Board transaction to be more predictable in terms of pricing, and then also when they want paid, especially local investors, those who buy the gold from the artisanal miners, they want to be sure that Gold Board will have the money to pay them anytime. If not, they will start smuggling it out. So these are the operational issues that must be addressed. So operational issues must be addressed. We have to make sure that Gold Board has the balance sheet, very big balance sheet, to be able to do these transactions, and this will make sure there's confidence in the market.
Great. Thanks for joining us for the exchange, Professor Williams Befra, Associate Professor of Finance at the Andrews University. Appreciate it. Well, from gold, let's talk about cocoa. Ghana's cocoa sector is weathering a sharp downturn in global prices, yet continues to deliver strong earnings for the country. Winston Taki has more in the following report.
Ghana's cocoa sector is showing resilience despite a sharp fall in global cocoa prices. International prices dropped by more than 8% in early January, pushing futures in New York and London to multi-week lows on the back of stronger supply expectations and weaker global demand. For Ghana, the world's second largest cocoa producer, the price volatility comes at a time when the sector's financial position has improved significantly. The Ghana Cocoa Board has reduced its debt by more than 11 billion cedis, strengthening its ability to support the farmers and maintain steady operations. Export earnings from Cocoa Board rose sharply in 2025, driven by higher producer prices, improved yields, and increased local processing. Farmer prices were raised by over 60% for the current season, helping to protect incomes amid global uncertainty. While demand has softened in parts of Asia and Europe, stronger production outlooks and better weather conditions across West Africa are supporting supply. Analysts say Cocoa Board's improved finances, timely payment to farmers, and investment in input are helping Ghana absorb external shocks.
All right, that's the marketplace. There is more news on our website, nigeriaonline.com/business. More on our top story. Government plans 10 billion in domestic infrastructure bond to fund roads, boost economic recovery. That plus other stories, nigeriaonline.com/business. We leave you with our Money Lab episode for today.
Welcome to Money Lab. My name is Paul Kofi Manti. I work with the EcoBank Group. We have been discussing personal finance, and today I want to bring your attention to one important area of financial planning, that is retirement. This is an area you need to pay attention to. I asked an important question. Have you seen somebody who is on retirement, who is struggling? If you have probably seen one, but remember this person was at a point in time working just like you. If you don't pay attention to this area, what you are seeing in the life of that person, you can see same in your life during your old age. The last time I checked, there are over 2 million Ghanaians who are over 60 years. Only 300,000 or less are on a state pension, and the few privileged who are on state pension are getting monthly pension of less than 5,000 Ghana cedis. You are already at the crossroads. Will you create a retirement that you want, or you take that one that shows up? If you don't create a retirement you want, you will not like what shows up. Remember, financial independence is possible. Many thanks for making time for Money Lab.